All right, we just wrapped up Module 5, Time Value of Money, and now we're going to move on to Module 6. And we're going to cover a couple different elements here in Module 6. One, we're going to do accounting for fixed assets and planning for capital budgeting. So these are going to be the two main focus of Module 6. And we're going to start with capital budgeting. Capital budgeting is the process used for analysis and selection of long-term investments of a business. So when we look at businesses, we are looking at, do they have the capital needed to make long-term investments? So that could be factories, it could be equipment, it could be new product lines. And so how do we analyze these projects, and then from a financial perspective, how do we decide whether or not to make the investment or not? Secondly, long-term investments such as equipment and buildings are large investments, and when we make these large investments, that's definitely going to impact the profitability of the company. We hope that these big-time investments that we're making are going to provide future revenue streams. And then finally, a business cannot rush into these decisions and must carefully analyze their options. So they must go through all the different options available and different financing options, or how they're going to obtain capital for the project. All right, so what are the steps in the capital budgeting process? The first thing, we have to identify an opportunity. So this is where our research and development, our sales force, our marketing, we want our basically ears to the ground. We want to see what the customer wants, and we identify an opportunity, a possible investment we could make. Then we select the appropriate investments. So once we identify it, then we select the investments that we want to make. We determine how to finance the investment. So once we have the project that we want to take on, it's up to the CFO and to kind of work the numbers to see which is the most appropriate and best way for the company to finance the investment project. And then we either accept or reject the opportunity, so we do an analysis of the investment. So those are basically the ways, the steps in doing it. And so now we're looking at capital sources. Where are we going to get the money? The first two are equity financing. So one, we could use net income that we've retained from prior periods. And so we could use our retained earnings to finance new operations forward. So when we think of Apple, when we look at Apple, for example, they got the ball rolling with iPods. iPods really infused that company with capital. They used that capital, the income that they made off the iPods, then to fund additional projects moving down the line, like the iPhone and the iPad, et cetera, and et cetera. Secondly, we could sell stock. So companies could sell stock and give away more ownership, and then through that ownership, they could use the proceeds from the sale to finance the investment. And then finally, we could definitely borrow money, so issue debt, borrow debt from bondholders, banks, the Fed, different ways where we could finance money. All right, evaluating the investment. A company must evaluate a potential capital expenditure to determine if it's capable of generating a satisfactory rate of return for the company. So what they have to do is they have to look at the potential of that expenditure in relation to, is it going to give us the revenue, the profits that we need in order to make the investment. And so if it costs us 10% to borrow the money, we better make sure that the project has a return higher than 10%. And that's what the second bullet point is saying. Any rate of return that is greater than the company's cost of capital is considered desirable. So the cost of capital represents the amount of return that the assets of the company must generate to satisfy both creditors and owners. So our debt holders are requiring a return, and our shareholders are requiring a return, and we must satisfy both parties when creating an investment decision. We calculate this by using a weighted average cost of debt and equity financing, which we'll get to in a second. The cost of debt financing is the rate of interest the creditors receive for use of their money. So if we borrow money at 10%, the cost of debt financing, the rate is 10%. And then the cost of equity financing is the rate of return the owners receive for the use of their money. So the shareholders are requiring a return off of their investment. So the money that they give the company, they're looking for a return, a stated rate also. All right, so here's the calculation. And so I'm going to kind of draw here for you a little bit to kind of visually show you what's going on. So the capital structure of this business is they have $4,000 in assets, they have $1,000 in liabilities, and $3,000 in owner's equity. So when we look at the way this is weighted, the overall liability to total assets comes out to 25% or 1/4. Owner's equity comes out to 3/4. So 3/4 of our assets are financed through equity financing, and 1/4 is financed through debt financing. So we're going to use these percentages along with the required return. So right now we're borrowing money at 12%, and our shareholders require a return of 16%. So to get the cost of capital, we're going to use the formula, the liability portion times the liability return, and then we're going to add the owner's equity portion times the owner's equity required return. So when we do that, the cost of capital is going to be 1/4 of 12% and 3/4 of 16%. So the 12 here times the 1/4 here, and that is going to give us the debt portion, and then we're going to use 16 and then the 3/4 to get to this percentage here. And then when we add the two up, we require in all projects, we require a return of 15%. So that's our cost of capital. It's otherwise known, you'll see it referred to in the text as the hurdle rate. So now that we have that 15%, we're going to go on and we're going to work through a problem here. So Russell Corporation capital structure consists of 2,690,000 of assets and 1.6 million of liabilities. Joe Russell, the corporate CEO and largest shareholder, says the debt has an average interest rate of 9% and that shareholders want a 16% return. So through this, we could get our weighted average cost of capital. So we're going to figure out our assets is there on the left, 2.69 million. There is the 1.6 million in liabilities, and so since we have those two, we could now get the equity portion at $1,090,000. All right, so now that we do that, we're going to get our weights off of that now that we have our figure. So our liability portion comes out to 59%, and our owner's equity comes out to 41%. And so now we're going to take those percentages and multiply it by the required return for both the debt holders and the equity, the shareholders. So here are the required returns. Debt comes out to 9, and there's the 16 from the information from the paragraph. And so now we're going to multiply that by the financing proportions. And we do that, we get a cost of capital of 11.87%. So that is the required return of all projects. So now we're going to use the technique, and I kind of showed you this before the Module 5 final. The net present analysis is a method of evaluating investments that uses the time value of money to assess whether the investment's expected rate of return is greater than the company's cost of capital. So what I just showed you is I showed you how to calculate the cost of capital. We're going to use that hurdle rate and discount our future cash flows of a project and put it into present value to see if we're making the right investment. So here's the 4-step process. First, we're going to estimate the timing and the amount of cash inflows and outflows associated with the potential investment over its anticipated life. 2, we're going to calculate the present value of the expected future cash flows using the company's cost of capital as the discount rate. And that's what we just did. 3, compute the net present value by subtracting the initial cash outflows necessary to acquire the asset from the present value of the future cash flows. And then we decide if we either make or reject the investment. If the net present value is 0 or positive, the proposed investment is acceptable. If net present value is negative, the company should reject the project. So it's a lot easier just to walk you through now a problem. A company wants to acquire equipment worth $750,000. The equipment is going to save the firm $250,000 per year over the next 4 years. The cost of the capital, the hurdle rate, is 10%. Should the firm purchase the equipment? So, when I read this problem, the first thing that jumps out at me is this an annuity? And the answer is yes, because the equipment is going to save the firm $250,000 per year. A lot of times we like to look at cash flow as making money or earning revenue, but in this instance, this problem is a little unique. because we're actually saving money. That $250,000 is a savings. So that piece of equipment is going to cause us to save $250,000 over the next 4 years. So this is an annuity problem, and what we need to do is we need to take those cash flows, we're going to discount them to present value dollars, and then sum those and compare it to the piece of equipment. So there's the cash flows of 250, 250, 250, 250. There's the cash outflow. And so we're going to find the present value. The net present value technique is find the present value of the future cash flows. So there's the annuity, because it's an annuity problem. We're solving for present value. The rate, we're going to use the hurdle rate. So this is the hurdle rate. We are using the hurdle rate as the discount. So we're bringing that, it's over 4 years, it's compounded annually. So the present value comes out to $792. The cost of the project, of the piece of equipment, excuse me, is $750,000. So if we look at that, our cash flows is greater than the $750. So therefore, we're going to accept the project. So we have a net present value. So when I say what is the net present value of the project, it's the present value of the future cash flows minus the initial investment. That is how you get the net present value. So on exam, if I say what is the net present value of this particular project, you get the present value of the cash flows, you minus the initial investment, and then you get the net present value. And we're going to accept it because it's positive. So there's your 4-step approach. Identify the cash flows, find the present value of the cash flows, compute net present value, and then accept or reject the proposal. And the decision rule is accept if it's 0 or positive. Alright, so now we have an uneven cash flow. Assume that the $750,000 piece of equipment is expected to generate the following cash flows. So now, as we look at this problem, this is not an annuity. We have to keep each cash flow, we have to discount and bring to present value under this technique. So cash inflows listed above, cash outflow of 0. So there's the cash flow. So now we need to find the present value of each cash flow. Now note, in year 1, the cash flow is 3. So our N is going to be 1 because we're going to get that cash flow 1 year from today. So we only need to discount it back for a time frame of 1 year. Year 2, notice our cash flow was 260. So now what we need to do is we need to take that 260 and discount it back to present value. And notice the only thing that changes here besides the future value is the N. We have to come back 2 years there. So now we go on to the third year. There's the 240, and we're discounting that 3 years. And notice our present values here. We're going to basically, if you can guess, what do you think we're going to do? We're going to add up the total of those 4 present values. We get $804,000. Once again, we get a positive NPV of $54,522, and we're going to accept because our net present value is positive. Alright, so let's do this problem. Gerard, a nonprofit entity, is considering the acquisition of baseball winder that costs $46,200. The baseball winder has an expected life of 10 years and expected to reduce production costs by $8,857 a year. Gerard's hurdle rate is 11%. What is the net present value of the project? Should they undertake the investment, and then why? So remember, when I read this problem, right now it jumps at me that there's an annuity because we're reducing production costs by $8,857 a year. So that's an even cash flow. The hurdle rate is 11%. We're looking at expected life of 10 years. And so since in this case it doesn't say anything about semi-annual, quarterly, we always go under the assumption that the discount time frame, the compounds per year, would be annual, so it would be 1 per year. So there's the annuity, there's the rate, compounds per year is 1, our N is 10 years, that's our time frame, So now we need to solve for the present value. The present value comes out to 52,160. And right there I know I'm greater than the cost. So I'm going to have a positive NPV there. The present value of the cash flows minus the initial investment gives me a net present value, and we're definitely going to accept. So now once again we have an uneven cash flow problem, and I want you to pause the computer right now and see if you could do this one on your own. Alright, once you had a chance to work through the problem, here is the answer. Now we need to look at the problem here. We have uneven cash flows, so we're discounting each one of those years back to 2008. So there's the present value of all those cash flows. The total present value. Now, it said, should they buy the copier? We always have to answer the question, should they buy the copier? The copier costs $42,600. It looks like our cash flows is coming in below that. So right there we know we should not buy because the NPV is negative. Alright, here's one last problem. The United Way is considering purchasing a new machine with a cost of $9,000, no salvage value, and a useful life of 5 years. The machine is expected to generate $2,850 in cash inflows during each year of the machine's 5-year life. Assuming United Way's hurdle rate is 14%, what is the maximum price United Way should pay for this machine? Alright, so this is a slightly different question here. It's saying what is the maximum price? So really what we're solving for the net present value of that even cash flow. So when we do that, when we put the $2,850, 5 years, compounds once per year, the hurdle rate of 14, we get a present value of $9,784.28. That is the maximum amount that they should pay for the machine. Okay, and so that's kind of what they're asking. And so the reasoning behind it, that is the present value of the future cash flows. That's kind of the why. And then it says compute the net present value. So when we look at that, the net present value comes out to being positive because there's the cost of the machine. We get a positive NPV, we should acquire the machine. So there you have it, folks. You have the basically the cost of capital, calculating the hurdle rate, and then from using that hurdle rate, we're going to use it in net present value analysis. And you definitely want to read the chapter of the book that kind of discusses that when I'm not in class. You have this 18-minute video to kind of look at and to go back and refresh, work through the problems, pause the video. You know, you have enough here to kind of keep you busy, and then I'll leave you additional problems for work. All right, good luck.